5 easy ways to short a trade. Today we're diving into 5 effective ways to go short in the market using various strategies. When you're looking to hedge your portfolio, speculate on a downside move, or diversify your short delta exposure, this segment gives you a breakdown of smart, capital-efficient alternatives to just selling stock. The problem with just selling stock is it's expensive. It's just like buying stock. Markets don't go up forever.
No, they do not.
And knowing how to position for a pullback, it's how we trade.
Yeah.
So let's explore it. Let's see what we got, Beth. Next slide. So for starters here, the team's using the QQQ. And there's a bunch of, on our platform, there's a bunch of different information right on the trade page. I usually go over it when we're doing kind of like a live show and stuff like that.
I go over it when I do my option trades today, which lucky for you is every Tuesday and Thursday. Today happens to be Tuesday.
But
wherever you find your podcast.
When you sell stock outright, your pop is going to be 50%. That's what it is. And your delta is going to be pure. It's minus 100. But the problem is the amount of capital that you have to put up to trade stock is usually similar to without borrowing money, it's similar to most account sizes. And when you start to borrow money, it gets, the numbers start to add up with the interest cost. So it's not the most effective way. You can see the top line there. Let's go. That's just 100 shares of stock. Takes almost $29,000. So let's go to the next slide. So we're going to get a little bit more creative here. And in this case, the first thing that they're going to do, Tony, and hopefully that you can see this, is they did a synthetic short.
Sure.
They sold a call and bought a put of the exact same strike. Now, it's the same thing as selling stock.
Yeah, it's a 50-50 shot, same amount of delta.
The pop's 50, the delta is the same, the profit's the same. The buying power goes from 28,600 down to 12,783. And the other nice thing about doing a synthetic short is you don't have to make it 100 deltas. You can move by just dragging on the platform, you can move your short calls up a little bit or down a little bit. You can move your short puts. You can make your long puts a little bit lower. Mm-hmm. You can do it for less deltas, costing less money, but you can do it for slightly less deltas. So you can adjust the delta. So you can basically adjust the number of shares.
Yep.
It's a very cool way of doing it. So rather than doing 79 shares, you can make it the equivalent of 79 shares by just adjusting the deltas. Let's go to the next slide. So now we start getting into different things. In this case, this is a skewed iron condor. This is where you have a call spread and a put spread where you're short both, okay? But you're short a call spread that's closer to the at the money, and you're short a bigger call spread. It's the simple answer. Mm-hmm. In this case, they did it equidistant away from the at the money, but they sold it doesn't look like it on the screen, but they actually sold a wider call spread than a put spread.
Yeah, it's $10 wide strikes to the top side, $5 on the bottom side. Yep.
So you can see here, the pop is going to be a little bit less because you're taking more risk, but the delta is negative, and your max profit, max loss, and your buying power, it's
significantly less than short.
Much more. This is very capital efficient.
Yes.
Way to look at it. It's a way to achieve short deltas with some capital efficiency. Sell a wide call spread, even though it doesn't look like it visually here, mm-hmm. and a narrow put spread. And you get a very different set of Greeks down at the bottom. You get a different pop, you get a different delta, and you still have all the same potential. It's just using a lot less capital. Let's go to the next slide. Or you could just go with a straight short call spread. And by selling an out of the money call spread to get short, you can go up to where you have 68% pop. You still have a negative delta. It's only 5 deltas, but it's a negative delta. That's just for a one lot. And your max profit, your max loss is obviously greater. and because you have a higher probability of profit, and your buying power reduction is even less. Simple, straightforward, but just all on the platform, all on a single page, all right in front of you. Let's go next slide. If you decide you want a little more bang for your buck with a little bit lower probability of profit, you can go for a long put spread. You can buy an out-of-the-money put, sell a further out-of-the-money put. In this case, you can adjust the strikes to anything you want. It's the same 5.3 deltas. This one has a pop of 44. So why would somebody do this? Because your max profit is greater than your max loss. We just flip-flopped the max profit, max loss. And the buying power is only the cost of the spread, or $158. So it's super cheap. You can make more than you lose. This is for the very bearish.
Very bearish.
Let's go next slide. Oh, so this is a summary page. We put this together for you so that you can go back to it as a reference guide. This is a summary of everything. This has the across the board. You can kind of see it, and you can break it down. Summary of every strategy.
I like it.
We did this just as a reference.
Yeah,
because our research should be really, really good. We want certain things to be evergreen, so you go back to it anytime you want. So you're like, okay, just in case I had a bunch of questions. The strategy, high level, the bias, credit or debit.
They all have a gimme and a gotcha. They all have to, but
how to profit and trade management. It's just a lot of stuff on this page, but it's a really clean way to look at a summary of all the different strategies and kind of concepts that we talked about and what you need to do. Okay, let's go to the last slide. So when you short a trade, be careful with the risk of unlimited losses. That means just selling like kind of a naked call or shorting stock outright. I'm less concerned with, to me, there's no difference between selling a call outright or selling a put outright or buying a stock or selling a stock. I look at it all the same way. But we argue that there are certain things you can do to give yourself a better chance. Selling call spreads wins 70% of the time if you do out-of-the-money call spreads. Buying put spreads you'll have lower wins, but you can make more money. Time decay is your friend when selling, your enemy when buying. Be the casino, not the gambler. I like that. Manage your trades early or take profits at 25 to 50%. Holding for max profit is where accounts go to die. The last half of the potential profit carries 80% of the risk. Small wins compound into wealth. The only strategy you need when bearish is selling the 20 to 30 delta call spreads 45 days out, manage close to 50% profit. I'm not so sure that's the only thing, because we do lots of other things, but our research shows that that's kind of the cleanest, the best bet for the money. If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.